Hey, welcome everyone. It is Tuesday, and that means we are calling all investors. We're live with Caeli Ridge here. Thanks for coming. Today we are going to talk about diversification. Go ahead, I dare you to say it. Diversification. If you didn't see if you didn't get the email and you have no idea what I'm talking about, it's a meme. Anyway, Caeli's going to talk to us all. Listen, there's a few ways to interact because we need your interaction. We want you to ask questions. We want you to hear what you have to say. Three ways to do that. You can either use the chat feature in Zoom, or you can use the Q&A in Zoom, or if you want to just ask your question directly, raise your virtual hand, and we'll go ahead and take your mic off and you can ask the question directly. As always, if you're listening to this replay and you have any questions about anything that you've heard, go ahead and put that question in the community, or you can call Ridge Lending at 855-74-RIDGE, or you can email to info@ridgelendinggroup.com. Caeli, you know what we're going to talk about today?
I have a clue. I have a guess.
Okay, diversification. Go.
Hi, everybody. Thanks, Larry. I was just going to say something, and it just escaped my mind. I was going to start with a funny joke, and I completely lost it. It'll come back to me. I'll share later. Thank you for being here. It's Tuesday, 1:30 Pacific time. I really appreciate you guys taking the time out of your busy day. I know how busy I get, so the fact that you're here with us means to me that you're serious about your goals and objectives within real estate. As Larry said, I really do want this today's show to be really interactive if you can, because a lot of it is going to be based on some of my personal experiences, the do's and the don'ts and the good and the bad. But I'm hoping for those of you that are maybe more established and even some newbies on the call that have questions, feel free to ask them. But I'm really going to try and engage our investors here that have some experience, a year, 2 years, 10 years, whatever it is, sharing some of what your experiences have been over the years, the things that you've learned. So I'll be asking for some of that interaction, guys. If you can hook me up, I'd really appreciate it. So yeah, diversification. This is such a big topic for me. I've taken some notes and I'm going to go through each one of them. The reason that this came up for this call, oh wait, that's what it was. This wasn't the joke, but this is something else that I wanted to ask you. I had my marching orders. Larry reminded me to ask you, for anybody that has been working with us or values the services that we provide in these weekly calls, or the education that we're always trying to put out there on the social, YouTubes, etc. We're looking for YouTube reviews. It's in our signature line. If you've ever received an email from any of us, especially recently, if you could and you're feeling benevolent, I would absolutely love it. We're trying to increase the number of reviews we have on there. And if it's less than 5 stars, come and talk to me first so that I can maybe figure out why it's less and help you or convince you to make it 5 stars. Okay, so diversification. So this came across my thought process, and why I wanted to do this today is I have lots of conversations with investors throughout the week, of course. And a lot of the newer investors that I've been talking to, I've kind of been noticing lately that I felt like they were setting themselves up to become like a 1 or 2-dimensional investor. And while I expect that over time, that'll probably correct itself. Trial and error will teach them the lessons that they need to know. But I thought that it would be appropriate to impart, based on, like I said, my experiences, and I hope yours too, how they can avoid some of those pitfalls. And as a result, in my case, diversification or lack thereof early on in my real estate investing was something that really hurt me, that didn't have to be that way if I had a broader base in my portfolio. So I want to go through some of the different nuances of diversification. I'll have feedback, and then I'm going to ask you guys for some interaction. Okay. Real quickly, let's go back to, and I won't bore you guys with my sob story, but just to kind of give anybody that doesn't already know this, early on, I was aggressively acquiring, and when I was doing this, this was early 2000s. This was a different cycle, real estate cycle. It largely, almost exclusively, was appreciation. Whereas if we fast forward to today and everything that we know about real estate investing, residentially especially, it's almost exclusively about cash flow, right? That was not the case for me. So I had a lot of investment properties, of which none of them were cash flowing. In fact, some of them at varying degrees were negative, $50, $100, $1,000. And don't get me wrong, I did very, very well. We did very, very well. But because I wasn't more diversified, I was a one-trick pony. And when stuff went bad, and it did in 08, 09, you guys those of you that are, 100 years old like me, you probably remember the housing and lending crash, right? So it was a problem for me. So diversification is top of mind for me when I'm having conversations. And some of you that are already signed up for our certified power buyer talks with me, some of this is going to sound familiar, but I think it bears repeating. Others of you that are not, I suggest that you get on that bandwagon. It's free, one-on-one time with me. But I talk especially in part one, I talk a lot about diversification. So without further ado, let me just kind of start getting into it. A balanced portfolio is ultimately going to enhance and optimize your long-term success. All right. Now, before I start getting into the bullet points here, I'm not suggesting that investors should know everything about all different facets. I am suggesting that you're probably going to have your core, right? Your core model, whatever that may be: single family residence, long-term renters, $100,000, $150,000 price point, right? With some other varying degrees of criteria. So you'll have your core, but I am suggesting that you're going to layer in some of these other models or other strategies or philosophies so that you have that nice balanced portfolio. Okay, so one of the first things that I start with when I have this discussion is we want to talk about market. What market are you interested in? Because ultimately, guys, market is going to be at the top. And while the rest of this isn't in any particular order necessarily, market is going to dictate most of the remaining criteria. You need to understand what market you want to be in, and more importantly, you need to understand why. Why are you in this particular market? And there probably is a reason if you've already done your research. And if you have no idea what market, that's okay too, right? That's part of what we're going to try and draw out in today's call. So you're in Tennessee or Memphis because it's in your backyard, maybe because you've got friends or family and a network in that area that you've got some eyeballs or boots on the ground. That's okay too. Maybe there's other research that you've done that says Memphis is a unique market because it's got this massive pool of generational renters. Whatever it may be, you need to understand your market first and foremost before you can layer in the rest of this. And it's going to be that primer, okay? Then we go into type. Single family residence, is it a duplex, triplex, fourplex that you're mostly interested in? A condo, maybe non-warrantable condos is something that you have a potential penchant for. Commercial property, if it's commercial, is it storage units? Is it multifamily? Is it 100-unit apartment complexes, mobile home parks, et cetera, et cetera? We want to understand what the type is. Price point, right? Are you just getting started? A lot of newer investors probably are going to be on the lower end of the spectrum to get started, maybe even really seasoned investors. It could be either. It doesn't necessarily, I don't mean to pigeonhole newer investors, but price point. Are you looking in markets where 80,000 is the average price point, or are you looking in more luxury areas where the price points are 700, 800, 1,000, 100,000, or million plus property prices, right? What is the price point for you? And it probably is going to change if you're going to be looking at single family versus 2 to 4 versus whatever, right? That's going to change if you're looking at it from that holistic perspective. What about tenant profile? Has anybody spent any time talking about what kind of tenant they're interested in securing? That's going to largely attach to the market, probably, right? If you're going to be near a hospital, or maybe you're going to be near a college, maybe you're near a FedEx, or maybe you've decided to go into a market where there's industry, booming industry, and the blue collar tenant is really the tenant that you prefer. Maybe Section 8 has worked really well for some people. And let's talk about those tenants and what Section 8 might mean for overall longevity, et cetera. Are you interested mostly in cash flow or appreciation? For those of you that have done the research, chances are very good you've already recognized that the higher the appreciation, the lower the cash flow, and vice versa. Now, in saying that, I will offer that there's always exceptions to every rule, right? There's going to be markets in which you probably can get some of both appreciation and cash flow. But overall, more often than not, especially for a single family long-term rental, higher appreciation, lower cash flow, and like I said, vice versa. A good balance of both of those is going to be key. Most people, when I ask that question, they're going to say that it's all about cash flow, which is fine. But I think, and when we dig into that aspect a little bit more, I think that's going to be short-sighted. You absolutely need to have some appreciation play in your portfolio for reasons that I'll discuss in a minute. Short-term, long-term, mid-term rental, some combination of all of those, depending on what your core strategy is. What class of property, A, B, C, D, right, and why? And then finally, and we probably won't spend too much time talking about this, unless you guys, well, if you guys have any ambition to learn more about this, maybe I'll bring somebody on, but alternative means of real estate investing that aren't about real property, right? Syndications, perhaps a little bit different, or maybe notes. Maybe you want to become a lender yourself and do private notes, private money loans to other investors or developers, right? That could be an alternative means of investing in real estate. So those are the primary criteria that I'm talking to my clients about to draw out, as it exists today, what are their preferences for each one of those things? And then we start to talk through the pros and the cons, or maybe additional detail that they may not have necessarily thought of or done any homework on, just to provide as much information as possible, so that they're making the most informed decision about how they want that balanced portfolio to look. Okay, so let's kind of hold on a second, guys. So yeah,
I was just going to just ask you to break 1 second. So for those that are just joining, just so you know, we're talking about diversification. If you have any questions, feel free to take yourself, notify me via Zoom, raising your virtual hand here, letting me know if you want to come off mute, or you can always ask your question through the Q&A or ask your question via chat. We are working to turn on the captions for those that are looking for those now. Thank you, Caeli.
Yeah. Okay, so let's talk about market really quickly. And like Larry said, guys, feel free to ask questions if you've got them. And then I want to maybe, Larry, is it easy to do a survey? Or it takes pre, or we'd have to have that pre done.
For the poll? No, I can get
For the poll, yeah. Okay,
give me what you want to ask.
Well, I'll come back to you in a second. So markets, guys, let's focus on the markets for, it's easiest to determine markets for appreciation and cash flow. And I'll give you just kind of on an average. Remember, everybody, we're licensed in 47 states. So I do have a unique perspective and lens. I get to see all of the appraisals, all of the leases. I kind of have a good understanding of average property taxes, right? National averages. Now, every market it can be wildly different. So keep that in mind. But I do have that perspective to see it from all of these different areas. The markets that I can tell you're going to find the highest appreciation are going to be the Sunbelt states, generally speaking, right? The Carolinas, the Florida, Texas, Georgia, right? Really, the outer edges of the United States are going to be the higher appreciating areas. And then generally speaking, the highest cash flow is going to be the interlocked cities. Remember, there are exceptions to the rule. And I want to be sure to comment too. I'm not suggesting that you go out and get an investment property that appreciates massively that has zero cash flow. I still agree and believe it has to cash flow, but you should be willing to give up a little bit here in cash flow to gain a little bit over here in appreciation. Okay, that should be part of everybody's strategy. Of all the differences that I'm going to kind of go through here, we're going to talk about here today, I think that cash flow and appreciation is probably the biggie. All right, so be thinking in those terms. And if you already have properties that are in appreciating areas, California, Pacific Northwest, the Northeast, et cetera, or all the other states that I mentioned, fantastic, right? Now we want to just focus our attention on the areas in which are going to get the best cash flow. Then the next would be anybody have any questions about market specific, or how do you go about finding or identifying a market that you'd be interested in? Anybody have any thoughts or comments about that?
There is one question here from Kim. The question is, how do you determine what would be a property with appreciation? I've only focused on cash flow so far.
So, I've used this before, guys. You guys, I'm going to give it to you again. Larry, maybe you can put it in the chat. FHFA, Federal Housing Finance Agency.gov is a great resource, remembering that these are the feds, so they've got a lot of time and energy and money and research into this. But you'll be able to go through, they've got some tools and data in there. I think one of them that's interesting is the top 100 in the nation of appreciating markets. So go through there and see if the markets that you're interested in or that you've considered are anywhere on that list. And if they're not, look for close enough cities. I mean, if you're on the outskirts or something, maybe it's there. It's just not, it's not displayed as one of the prime cities. And it'll tell you, you'll be able to find in this website past appreciation numbers, current, and then it'll even forecast futuristically what they expect the appreciation to be. Okay, so those things I believe are going to be wholly important to maximizing. Before I move on from market or cash flow and appreciation, this is going to seem maybe like a silly question. Does anybody want to just chime in? You can type it in if you want to. Why is appreciation such a big part of real estate investing? I know cash flow, right? We all know cash flow. It has to cash flow. I wouldn't buy a property. That's not true. I am in a situation where there may be some incentive for me to buy a property that was at a loss right now. I'm happy to share with you why later, but that's not going to be my focus. But why is appreciation such a big part of residential real estate investing? Does anybody want to just quickly answer that? And you can raise your hand, we'll take you off mute. It's not a test. There's no right or wrong answer for sure. Everybody's circumstances and goals are unique and specific to their needs.
No one is
Okay.
willing to step forward to answer that question, Caeli.
Okay, that's okay. So the answer is with appreciation, guys, you're going to be able to harvest equity to utilize for more acquisition probably. Right? Borrowed funds are tax deductible on an investment property. So if you are balanced in having massive cash flow properties over here and maybe 1 or 2 properties in markets that you've got some great appreciation, you give it 3, 5, 7 years, whatever, you're going to be able to utilize that property, leverage, right? We're going to harvest equity. We're going to do cash out refinance. Maybe you even do a 1031 exchange, but you're going to utilize that appreciation play and use those proceeds to buy more investment properties, right? Most of us are not in a situation where we have the means to plunk away hundreds of thousands of dollars to build an empire of investment properties over a 5 or 10 or 20 year period of time, where it's just coming from our day job and monthly savings. That equity in properties is largely where people tap into. Maybe it's their retirement accounts as well, but the properties themselves is very common where real estate investors will go to tap into down payments for more acquisition. So appreciation, I think, is it should be at the top of the list of things you want to be considering, at least from, you know, a smaller perspective. You look at your portfolio, the majority is high cash flow. Okay, you should have a nice chunk of that for appreciation in the markets that I've already just defined or discussed.
So just to give everybody a heads up, so in the chat, and by the way, keep the questions coming. We got a ton of responses for you, Caeli, to go through if you're ready. But I did post the FHFA link that brings you right to the house price indices. That's what you were referring to earlier.
Yeah, it's one of the places. Yeah, go mess around in there, guys. You may have to drill down in a few different pages, but there's a lot of great data in there. Okay, so market, I think, is really key, and that's probably the first piece that you want to define. Then we get into type, single family, 2 to 4, commercial, whatever it is. I'm going to keep this on the residential side because that's most of who we cater to is residential real estate investors. You know, another thing you want to be asking yourself is how risk forward are you? How risk averse are you? If you're super risk averse, let's say that you're in your 70s, right? And you're just kind of getting into this. You're not super jazzed about what your retirement plan ended up being. You want to diversify a little bit, get into real estate. You're probably going to be pretty risk averse, right? More often than not, in which case that individual, and we'll weed this out talking one-on-one, right? If you don't know, maybe you don't know if you're risk averse or risk aggressive. But if you're, let's say, risk averse, you're going to be looking for single family residence on a long-term renter basis in a lower price point, right? That's going to be the least risk possible in real estate investing, as far as I'm concerned. Single family, 80,000 to 150,000, and getting a long-term renter in there. Okay. But what you're giving up, if that's all that you're going after, it's going to take you a lot longer, a long time before you're able to amass anything of substance in a passive income play. And if I had to guess, most of us here on this call today are interested in the passive income. Okay, the average, national average, and I'll give you the characteristics that I'm using to give you the statistic. The national average in cash flow, monthly cash flow, is about, well, right now, even in a higher rate environment, 250 to 325. Okay, that's as it exists today based on these characteristics. Single family residence, $125,000 purchase price. I'm using 0.9 in the gross rents. I used to use the 1% rule, right? If the purchase price was 125, we can expect the rents to be 1250. I've backed that off a little bit just to be conservative. So I'm using 0.9 in the gross rents. I'm using an average, national average of taxes. Those of you that are in multiple markets, you know that property taxes, I'll use Texas, for example, very, very high. Property taxes in Alabama, very, very low, right? So using a national average for property taxes, using an average interest rate of say 7% on a 30-year fixed, property management at 10%, all of those variables in there, that's going to be your spread, 250 to 325. Okay. How many of those would you have to amass in order to make $5,000 of monthly passive income? Well, let's just do the math really quick. Okay. This is some of the stuff that I do with my clients. So 250, 325, let's go middle of the road and call it 285. Okay. 285 is on a conservative basis. Now I'm not taking vacancy or maintenance in here. Okay. That's not included, but I'm being hyper conservative in some of these other areas. So let's say 285, and I want to make $5,000 a month of passive income. Okay. Somebody did the math for me. 5,000 divided by
is it 17?
285, 17.54. Very good. Thank you, Messiah. 17 of those properties. Now, for a lot of people, that's going to sound like a big number, right? I have to get 17 of those things before, right? And this is with leverage. At some point, maybe your phase one is to purchase these properties. And then phase two, you're looking at, 7 or 10 years down the road, you're going to snowball and take the passive income and start paying, rapidly accelerating the payoff of the mortgage debt. So then you're left with free and clear properties, at which point, maybe you only need 9 of them, right? Whatever that math may be doing. But instead, right, instead of that philosophy, why not look at it and say, okay, I want the least amount of risk possible. This is my model. However, I want to reach my goal in 6 years, not 20, in which case then I know I have to start layering in a 2 to 4 unit property, 1 or 2. Okay, because we know that I'm going to get more cash flow doing it that way. I'm also going to look at a midterm or a short-term rental, 1 or 2 of those. One of the things that I have been speaking about a lot lately, and I'll share it with you really quickly. I think I'm jumping ahead, but that's okay. And the trick here is going to be to find this golden unicorn. But what if you could find a fourplex in a market that's going to produce appreciation? Okay, I usually use Florida. Florida is typically one of those states that is going to have higher appreciation. Okay. And you have to make sure that you find this property, this golden unicorn, in a market where the municipality and the township still allows for short-term rental. But you've got this one property where you're going to say 1 or 2 of the units is going to be reserved for a long-term renter, and you're going to reserve 1 or 2 of the units for a midterm and a short-term, right? You've got one property that can encumber or accommodate a variety of objectives all in one. That might be a great way to balance and get that diversity into your portfolio. Okay, maybe I should open up for questions, Lara, before I go down the list.
Yeah, if you're ready, we've got a couple of others.
Okay.
I think the first one we've got that's worthwhile here is Sequoia asks, they're in North Carolina. What's your feeling of like trying to figure out the next hot city in any particular state?
Very good question, Sequoia. Thank you for asking that. I would probably look to the turnkeys. There's a lot of them out there. Most of you probably came to us from the different turnkeys, mostly the national ones that focus on education, because they're spending an inordinate amount of time vetting that and researching that. So I would see where they're looking. Otherwise, start looking in areas where the big boys are opening, FedEx, right? Follow the money. Where they're going to be businesses, so 2 things I would answer for that. States in which you're going to start seeing lots of tax incentives for businesses, small or otherwise businesses, where the states they're trying to bring in more revenue, more income. So that would be the first thing. The other thing is look for Walmarts, look for Nikes, look for Costco's. Where are those, big boys going to start building or making a footprint there? That might be one way that you can do it. I know that there's a lot more to it. So hopefully that answers Sequoia, probably not completely, but the turnkeys should know. They should be able to tell you where those markets are going to be. And then I guess maybe in closing for that, I would say that look for the markets that aren't as saturated, right? I can tell you from my perspective, the ones that I don't see very much of, when I do see them, the returns, the cash flows look good, and they're, because I don't see them very often, I assume that there's not as much competition. So Oklahoma is a unique area that I don't see too much interest in. I have no third party or turnkey relationships there. I've actually been considering for the last year and a half taking a trip just to, spend a weekend in one of the major cities to see what turnkeys are doing down there, look at the different properties, because I've seen appraisals come back and cash flow for a $175,000 property, even as recent as I want to say it was November of last year, was like $500 a month. And in these, higher interest rate environment, that's a big number to me on a single family, right? Going back to my model, single family, long-term rental. So I guess, the other thing, an easy way to do it would be dial for dollars, man. Go look at some of the different markets that just aren't maybe on top of the radar that you hear often. The big guys that you guys are always hearing about, I'm going to tell you what they are. They're either the Carolinas, Florida, Texas, Georgia, Ohio, Missouri, Tennessee, Alabama, Indiana, right? I probably covered most of them. Yeah, most of you will probably agree that, yeah, those are the ones, Illinois, maybe, those are the ones that you hear most of people talking about. So go outside of the confines of that, Pennsylvania, maybe Baltimore, just kind of outside of the confines and see what some of those other areas offer, right? Google, dear Google, turnkey in Timbuktu, Iowa, right? See what the numbers look like. You probably be able to get quite a bit from just doing a Google search. Next, sorry, Larry.
No, you did great. And so this is one of those moments where, I'm sure you can probably speak to the investment profile, right? So understanding what your investment profile is something you can help people, can't you, Caeli?
Yes, thank you. A great segue. So guys, one of the things Larry and I are really invested in trying to bring to you, especially the newer investors that need that extra direction. All they know is they want to invest in real estate, right? They want to be diversified, or they don't want to be in the stock market, whatever it is. They want to be in real estate, but they have no idea how to begin. We get a tremendous amount of interest from investors that come to us with TBDs, right? They don't have properties identified yet, and they just don't know what to do with their money. They don't know what to do with it. So Larry and I have spent lots and lots of time trying to connect that need with the want, right? The mother of all invention. So we have a questionnaire that we're putting together, and also a draft of a 10-minute analysis where you can quickly identify, just quickly off the cuff, if this particular property fits within the mold of your goals, right? The returns, the ROI that you're expecting, and then we'll be able to connect you with the turnkey that has that particular inventory. So I don't know if I want to say an ETA on that, but it should be in the next
At least the next 12 or 13 hours, at least.
Yeah, okay, right.
Yeah.
We'll be able to launch it until we're 13. Yeah, so we'll have all of that. I think we'll probably put it in the community, right, Larry?
Correct. I'm sure. Yeah, we'll definitely put it in the community. And the idea is that, how many times have we come across folks who, again, want to do something, but don't really know what they don't know and how to organize that desire to want to invest, but we need to help kind of put it into numbers.
Yeah, applicable.
Cool.
Okay.
We've got a couple more questions, Caeli, if you're up for it.
Yep.
So Veronica asks a really great question where, you're talking a lot about areas that maybe not a lot of people live in who are on the call today. So Veronica happens to be in a cash flow market, and moving outside of Veronica's local area feels very uncomfortable. So if you have somebody who doesn't want to necessarily go out of their comfort zone, but they do want to achieve diversity locally, any insights on how to do that?
That's a good question. First of all, I get it, especially for a newer investor. I thought it was very unsettling too, to think about buying an investment property that I couldn't drive by and see for myself, right? Let alone not have toured. So I fully understand that. And especially as a newer investor, I almost encourage that. Do it in your backyard, just until you get some sea legs. But if you're just steadfast, I may argue with you a little bit on the point that you only keep your investment in one state. I think that's dangerous. I personally can tell you that when I kind of operated in that vein, where I had way too many eggs in one basket, and something within that market happens, you're going to be in trouble. So I would say that diversify that market, man. Even if it's just, you know, a few eggs over here, have something as a backup. But so I think the question was, and I'm so sorry, I forgot the name that asked this, but you want to be able to have cash flow, but you want to diversify within one market. Let's say that it's Indiana, okay? Whatever the market is. I don't think it's going to be that hard to find different cities and within those cities neighborhoods that are going to provide that for you. You know, there should be in every market, in every city of the US where you're going to have more or less cash flow. I think the key is ultimately going to boil down to the type and then the tenant. And the tenant is going to be largely attached to that property manager, which I didn't focus on in my checklist. But we probably should talk about how important property management is. And I guess it's not necessarily diversification, but you should be vetting property management heavily, maybe even more than the market. Or once you find the market, that might be the second thing. There's probably some national property managements too that could do the job. I don't know if I answered the question, but I would just, you're going to have to do the math. You're going to have to go out there and start looking at the different. Well, if you're trying to do it with just a real estate agent, or just for sale by owner, that's going to be a lot harder. I would say for the first run, you probably want to use some kind of a turnkey that's already done all that work for you so that you can learn from them. And then if you want to go out and do it on your own, you've got a basis, you've got a baseline of which to operate from.
That's great, Caeli. And I think a lot of the information you talked about with different property types, short-term, long-term rentals, depending on how big the local market really is. I mean, is your local market all of Philadelphia, or is it a small town? Like what is your local market? That would make a difference too, I imagine,
Sure.
wouldn't it?
Yeah, absolutely. 100%.
Okay.
And so just real quick, but before you go on to the next question, you can ask in a second, Larry. For anybody that has any advice on any of these questions, you guys chime in. I want to hear from you. I know everybody else wants to hear. If you have experience that you can speak to the group, this is a community. So please feel free to share. Okay, Larry, I'm ready.
Yeah, no, and for those that do want to, if you feel like you have something to share, go ahead and raise your hand or send me a note through one of the options here in Zoom, and we'll get it figured out. The only other question that was really out there, you brought up Texas. So Martha says, listen, I'm in Texas, and Texas is very difficult to pull cash out. It's just one of those things. So any advice on folks in Texas how to get additional cash out of their properties?
So not cash out as in cash flow, just actually harvesting equity in the property. Is
Yeah,
that the
pull the
question?
equity out. Sorry about that. Yep.
Okay, yeah. So non-owner occupieds do not have the same, you're right. Texas is funky. Texas has got some really restrictive HELOC and cash out refinance rules for owner occupied for primary residence. So if that's what we're talking about, maybe we can talk offline. I know that there are means in which you can do that, but for non-owner occupied, they don't apply. So if you have a rental in Texas, you shouldn't be hit with the same restriction or criteria that you would if it was a primary residence.
There you go. And if any more questions, by the way, again, anything that you're listening to, whether you're here or you listen to a replay, if you have any questions, you want to get in deeper, feel free to call Caeli at 855-74-RIDGE, or you can email to info@ridgelendinggroup.com. Caeli, you got another question here. You mentioned turnkey a couple of times.
Mm-hmm.
What is a turnkey, and how would you get research from them and whoever they are?
Yeah. So a turnkey is a group, and there can be local turnkeys within the market that you're looking in, or there can be national turnkeys that have wholesalers in individual groups. A national turnkey probably has 10 different markets that they vetted that they're in, that they can offer inventory to their group investors. And a turnkey is going to be someone that has found the property or found the wholesaler to find the property, that has done all the renovation or rehab necessary, and has the property management within the turnkey. Now, the property management may not be a part of the turnkey company, but it may be a subset or a relationship outside of close net relationship that handles all of the tenant, borrower and tenant relations. So turnkey is meant that you're not going out there and finding the property yourself, figuring out who the general contractors are going to be to get the property rent ready or to do the upgrades or rehab that is necessary. And you're not going to be out there on your own trying to figure out who the property manager is. So turnkey is kind of the group that's going to handle all of that, keeping in mind that if you go for a turnkey, the price point, the property itself is probably going to be a commission or so in excess of what you might be able to find on the open market yourself, right? So you're going to pay for that knowledge and those resources. But if you're brand new to this and just getting into your first, I would strongly recommend using a turnkey, at least for your first. Pay very close attention and utilize a turnkey that does focus on education. The big ones out there are going to be Real Wealth Network, Get Rich Education, Dan Lane's Rental Income Podcast, although those last two are more for information. I think they may have some recommendations for turnkeys. Epic Real Estate, Narada, there's lots of them, guys.
You have Angel would like to go ahead and ask a question. So Angel, I've gone ahead and click the button to ask you to unmute. So you should be able to go ahead. Oh, and hopefully that worked. Let me try it one more time. There we go. Angel.
Oh, no, one of the suggestions for people saying about how to generate equity or value for your properties, you got to look at how you can add a bonus room, a bathroom, upgrade something to the property as it is. And that way you can, because, if it's, that's the only way you can do it. You upgrade it, make a facelift, make it look nicer, get an extra, upgrade the garage. That will automatically, every money you put in, you'll be able to get it back once the new appraisal comes in. And then, like I said, the way with after COVID, people do appreciate if you add a home office, right? Or you add an extra room. No matter, yeah, they'll do. That's something that brings value now, because that is something that people are looking for is, okay, if I can have a good home office, that maybe you can create an area where, you don't need to have a big, large, nobody likes, the big open areas, gives you that opportunity. So that's an idea. I created some equity in the past.
And cash flow too, right, Angel? Yeah, I think that would accomplish both things. I think that's a good point. And guys, we have bridge loans where if you have properties that if your model is, I think what he's really talking about is potentially looking for more distressed properties. Where it's under market value to start with. You're going to put in some lipstick, perhaps, maybe more. Maybe, like you said, you're going to add a bedroom. Maybe it's going to be a more of a major renovation, right? Where you might put an ADU in there, or something of a bigger scale. We have bridge loan money where you can buy the property. So those loans are typically, just really quickly, you're looking at 80% of the purchase price, whatever the purchase price of the property, and 100% of the rehab. So if the purchase price was $100,000, I'm going to give you 80% of that, 80,000. And if the rehab was 100 grand, I'm going to give you 100 grand of the rehab. So $180,000 loan. And as long as the ARV after repair value comes in at 75%, you guys can get that money all day long. That would be probably a home run. Then you refinance it out of the bridge loan, depending on how long it takes to do the renovation. Right. But you've got to, that's a little bit more in depth. Obviously, you got to be sure that you know what it's going to rent for and what kind of return you're going to get after all of this. But I love that strategy. I think it takes a little bit more attention to detail. Right. But for those that have been doing this long enough, I love to see those. Thank you for the feedback, Angel. Anybody else, Larry? Should I go through some of the rest of this?
So I think this is from Veronica also, and I think it's really reflective. I think maybe 18 months ago, 24 months ago, there was a lot of talk about short-term rentals, hot stuff, right? And so Veronica's just response is, we own 7 long-term rentals, but looking to get a short-term rental just a few miles from us near a golf course. And short-term rentals just seem like a fad right now, and my husband isn't keen on breaking into that market. What do you think, Caeli?
I'm going to disagree. I think that in the right market, now a fad or not, I don't think short-term rentals are going anywhere. I think that the pandemic for sure spurred a spark or created a real need to get out and get out of the house. But I don't think that short-term rentals are going anywhere. I do think that you want to make sure that you're maybe multi-purposing it and having backup strategies, because, right, what if the market for the short-term rental, you don't get as much occupancy for the year. So you want to have plans B and plan C if you need them. That's going to be important for any strategy. There was something else about short-term rental I was just going to mention too. Oh, you know, there may be some opportunity as well to look at a property for short-term rental that you may be willing or wanting to use for your own purposes, right? So for 2 weeks out of the year, maybe you're going to use it for your own vacation, family vacation. That would probably add into its benefit and help with the return, right? If you're going to be using it for some of your own purposes. I would do your homework though. Short-term rental, I mean, it's a very different model. So make sure that you've got the right property manager. That's going to be really, really key for short-term rental. And whatever you're being told for the vacancy, the annual vacancy or rental rates, do your own due diligence about it. Make sure that those numbers are accurate. But I think that I don't see too many instances where somebody gets into a short-term rental where it ends up being a complete loss. Maybe it wasn't as I have seen where it wasn't as great a return as they thought, but the returns are still solid and they're still higher than the long-term rental, the single-family long-term rental.
That is all the questions and comments we have for now, Caeli.
Okay. Let's go through just a couple other things, and then I wanted to ask if there's. So here's what I'm going to ask for those of you investors that have been doing this long enough. I want to know if anybody has Section 8 experience that they want to share with the group. And then there was something else I'll remember in a second. Let me go through my list. So I think we talked about price point, right? We talked about property type, diversification, property type, the single family, the 2 to 4, the condo, the commercial, mobile home park, storage units, whatever. Have some diversification there. Do the research first, of course. Price point is going to range, but depending on the property type, but anywhere from 80,000 to, it could be a few million. Cash flow appreciation, make sure you've got some appreciation there, guys. I think it's very, very important to have some appreciation. Maybe only 10% of your portfolio, but you really want to have some appreciation play in there. It should cash flow. Maybe not as well as the other ones, but it should cash flow. We touched on single or short-term and long-term. Let's talk about midterm really quickly. Midterm might be the happy medium for some people, where you guys are aware of this. You've got the traveling professionals. You've got pilots, flight attendants, nurses, doctors, whomever may be on regular basis to be traveling. Those seem to be doing very, very well. I like that model because it may take, like I said a second ago, take out some of the risk of the shorter term, and most of those leases are anywhere from 30 to 90 days, sometimes even 6 months. Something else that's very cool, check this out. I heard about this late last year, and I haven't done any of my own real tight research yet, but on a midterm rental basis, in the states in which have all the major professional sports teams, you got the football and the baseball and the basketball and the soccer and hockey, whatever. There is a new investment model, and maybe it's not so new. Maybe I was just not smart enough to pick up on it. But you have higher end properties, maybe 500,000 to $1 million plus, where these things are rented for years in advance to the individual players that they don't live in Ohio, for example, right? They're traveling from home for the basketball season or for the football season or whatever it is, and they need a home. They need a place to stay. These individuals, typically, if they're professional athletes, they're making enough money that they can afford to be living in and want to be living in a 400,000, 500,000, right, so on and so forth. So the price points are going to be higher. But what I'm hearing and what I saw, at least from the documentation that the agent sent over to me in this model, it was in Ohio, if I remember correctly. They're rented for 3 years in advance. They're signing their leases for years in advance because they want to have that place to stay. It's a very popular strategy right now. So that might be something else to consider on the midterm. And remember, the least amount of risk, what happens to our return, right? It's going to be lower. The higher the risk, the higher the return. So keep that in mind. And that's another part of the balance, balancing risk versus return. We didn't talk about class A, B, C, D. Sweet spot typically for cash flow is going to be B and C. I didn't really get into too much of the D class properties. I know there's investors out there that do extremely well in the lower class properties. So if anybody is, that's kind of their focus, that wants to speak to the group about, details of D class, fantastic. A class is going to be probably more on the range of the short term and the midterm. And then I talked briefly about the syndication and notes. I don't think I'm going to touch on that. Why don't we, I just said a second ago, I was going to come back to something and I forgot what it was. Are there any updated questions, Larry, while I'm trying to remember?
While you're trying to remember, we had a couple of people. So Lisa let us know that she's got Section 8 experience. Kevin's got experience with some traveling nurses. Sequoia was asking if anyone had any experience with assisted living homes. And then there was a couple of questions. One was, do you advertise the MTR as an air, like the month MTR? Sorry, what is my MTR?
Midterm rental.
Oh, okay, there you go.
Yeah.
See, I'm learning too. So is that really, do you do that on Airbnb? Like, where can you find out more information about that?
Where do you advertise for it? Yeah. You could on Airbnb, VRBO, Vacasa might be another one. Vacasa, by the way, guys, although, I feel like they will advertise, you just have to have your minimum, right? If it's 30 days. And I think that by definition, the midterm has to be a minimum of 30-day leases, right? And while I mentioned that, I will tell you that VRBO and Airbnb, those are just staging sites to showcase the property, right? I mean, I know that a lot of them can collect payment right there, but they don't handle any of the maintenance or the cleaning or the the furniture or the accounting, right? It's really just to showcase the property. Check out Vacasa. I believe that they are more all-inclusive and they can do all of that stuff. So that might be for a short or midterm rental. Lisa, do you want to share anything about Section 8? Is there anything, maybe just pitfall or something, if there was one thing or one nugget that you would share with people about Section 8 for them to be aware of, what would it be?
Well,
You're
we're
on
gonna
mute,
have to get
please.
Lisa, yeah, because we have to get her off mute.
Oh, sorry.
It's
Sorry.
okay. Or we've sent her a message to ask to unmute. Let's see if.
No, that worked. I would just say my one thing is make sure that you vet the tenants just as you would any other tenant. People think that Section 8 is like some sort of golden ticket and it's great because the government pays. And you think that if the tenant doesn't behave, them getting kicked off Section 8 is a detriment. To a lot of them it is, but I've had great Section 8 tenants and I had some really shitty ones too. So, and the shitty ones I inherited. So my advice would be to just vet them the same as you would any other tenant.
And thank you, Lisa. And for that, guys, if you're going to be doing your own vetting, you know the questions, right? You want to see, well, you probably want to ask a property management how they're going to do it so that you really, really understand what to go for. But you want to see, 3 months worth of income in a bank statement. You can pull credit, right? See if they've got a blatant disregard. That would be a red flag, obviously. They want their income to be about 30% of the rent, I think is the average. So there's a few just key points that you want to gather data and make sure that they fit the mold. You'll be able to tell pretty quickly if you go through those steps, if you're likely to have problems.
Take a look at their cars when you when do the in-person meeting and take a look at their car and see what their car looks like. And if the car looks like shit, then they're going to treat your house like shit. So that's
probably a good marker. That's probably not a bad way to look at it. Yeah.
It's hard with the Section 8 tenants with the financial standpoint because you can't really just look at like bank statements and say, oh, they can't afford it, because they can't afford it. That's the whole point. You're trying to just gauge them as people and how they're going to treat your property. And whatever you come up with as far as whatever that looks like, just make sure that you have some sort of system in place for it. Because I've just had a lot of colleagues that are like, they get all excited about Section 8 and the government paying, and they take any Section 8 tenant, and then they end up with, I mean, I was on the receiving end of it with a lot of damage and a tenant that's not going to pay for the damage, and then they disappear in the middle of the night, and you're left with, thousands of dollars in make readies, and it's just, yeah.
Lisa, is there, obviously it's going to be state or city specific eviction processes. Is there anything about Section 8 that, in addition to whatever the city or state law is about eviction, that changes?
I'm not that familiar with the eviction process to really say one way or the other, but if they have a lease, and if they don't follow the terms of the lease, then they get evicted just like anybody else. But
Right. But there's nothing about Section 8 necessarily that would, since someone else is making there, maybe there's something more that could be done to get them out. No,
I
you don't
think
know.
there might be, if you go through the Section 8, whatever housing authority it is, there might be provisions. That's just something to check, because it's going to vary based on which authority it is. That,
Yeah, okay.
because I have one tenant that's still Section 8, and it's some charity pays her, so it's a different scenario. So it depends on where they come from, but there is some other provisions, because once they get evicted, they can't get on Section 8 again. So if it's one strike, so they lose their eligibility going forward, which theoretically should be a detriment to them.
Not always.
Not always.
Okay, good point. Thanks, Lise.
Yeah.
Somebody else had a comment or maybe, well, what time do we have? Oh gosh, wow, look at that. Holy cow, time flies when you're having fun.
We are, we are rounding out the hour here. Michelle Spradley did have a quick question.
Okay, all right.
I want to take her off because she's awesome for volunteering here. So Michelle, you have the opportunity to take yourself off mute if you want.
Okay, thank you, Larry.
Hi, Michelle.
Hello, and thanks, as always, Caeli. I just wanted to kind of piggyback on what Lisa was saying. I agree with everything she was saying, but just wanted to add one other thing, is that they have a tendency sometimes to the housing authority itself not want to pay us market rent. So you have to stick to your guns. And I had a tenant who did not want a rent increase during the well, it was after the pandemic. We were going to increase the rent by $100 because we hadn't had one in like 3 years, and she kicked and screamed. So we just did not renew the lease, and we got a $600 increase in rent. Yes, and that's
Now,
one
was
of the
it
ones you all finance, Caeli.
Wow, Michelle,
Yes.
was it Section 8 still, or did you go outside Section 8?
Went outside Section 8.
Wow, $600.
Yeah.
Wow.
Yeah.
That's a feel good story.
Oh yeah, definitely.
I like that. Great, thank you for sharing that. Okay, so he's going to be on. We're going to wrap up here. For anyone that's going to watch this after the fact, they've got a long one to attend to. Maybe we didn't cover everything. I'm going to be looking to you guys for content that you want to hear. Please let us know in the community anything that we have talked about in the past. We haven't talked about anything that's top of mind for you that you feel like would be of value. Please let me know. If I know enough to speak about it, I will absolutely add it to our list. If I don't, I'm going to bring somebody in. I do want to start to get back into having guest speakers, so I'm working on that. I have a day job, so I wish I was doing this full time. If I was, yeah, okay. Okay, what else, Larry? Close us out, buddy.
I'm just imagining you talking all day over this stuff, because you are a wealth of knowledge, and everybody loves listening to what you have to say. So I'm going to reiterate what Caeli just said in case you didn't hear her loud and clear. This is a community call, and this is really for you, both the folks that spend your time here to come today, as well as those that participate in the Ridge Lending Group community. We want to really hear from you and what you want to hear from us, and mostly what you want to hear from Caeli. So to do that, please go ahead and either leave a comment in the community post when we push this out on replay, or go ahead and just email to info@ridgelendinggroup.com and say, Caeli, I want to hear about this, and she'll set it up. You can call 855-74-RIDGE, or again, email the info@ridgelendinggroup.com. And if you really want to get going, if you want to understand what that investment profile is all about, or even find out more about the certified power buyer, you can go on ridgelendinggroup.com and you can start your certified power buyer. You can apply anytime. There's no cost to apply. Obviously, there are other situations involved that you can speak to Caeli about directly, or a dedicated lending specialist. And that is my entire script, Caeli. I've got nothing else to say, but thank you.
Thank you guys for being here. We're on standby if you need anything at all. We'll see you next week. Bye, gang.